Wednesday, March 11th, and the S&P closed down slightly in the red. The good news was that the International Energy Agency, which consists of 32 different countries, agreed to release 400 million barrels, which equates to about 1.2 million barrels per day, which unfortunately is not going to make up for the deficit that is being locked in to the Persian Gulf and not flowing out of there. Also, there were 3 more ships that were attacked by Iran, which brings the total to 13 ships over the last 2 weeks. So the oil markets weighed the good and the bad news, unfortunately leaning to the latter, and oil prices were up another 5% today. A couple of things that I ran across that just anecdotes about energy and oil. One is that right now, those tankers that are sitting on either side of the Strait of Hormuz are paying up to $750,000 per day in insurance alone, which I found staggering. Of course, that equates to higher prices at some point. The other was that there are two types of fuel that are especially susceptible to because they can't be stored like gasoline. And those two fuels are jet fuel and diesel. Those are thicker, more viscous fuels. And so when there's condensation in the tanks, they separate even more between the fuel and the water underneath. And at that layer, there's a lot of microbial growth, organic growth, and also oxidation. And so that makes it much harder to effectively store, and then later use these two fuels, jet fuel and diesel. So I'm keeping an eye on those as they're especially prone to sharp increases in prices. So enough focus on oil. There's so much focus on oil right now that I do want to dive a little bit deeper in other imports and exports coming in and out of the Persian Gulf, because this is huge and I feel like it's not being talked about enough. And things that come out of the Persian Gulf, fertilizer, which of course goes into food, and right now is the planting season in the US and other places around the world. And so, food prices and how susceptible we all are to food prices is greatly influenced. Also, polymers and plastics, which are used in medical devices and packaging, and also the metals. Because of the cheap energy in the Gulf states, they have huge metal smelting facilities and make high-grade aluminum that's used in cars and aerospace as well. And so these are all just some things that come out of the Persian Gulf and the UAE. The United Arab Emirates, for example, is known as the world's warehouse. They bring in electronics, autos, machineries, housing material, and then they re-export those to other countries. So what I'm trying to point out is there is a huge, past oil, there's a huge effect on the world supply chain. And of course, then the inflation, worldwide inflation, and suppression of economic growth around the world just from this one area. So I'm keeping an eye on that, and I want to make everyone aware, let everyone know that there's far more at stake here than oil. Remember, oil, as far as the 11 stock sectors that we focus on, oil is only 3% of those 11, that sector is only 3% of the 11 sectors. So there's much more at stake here with worldwide supply chains and inflation and growth. So something else that I found out was that most of the oil leaving the Persian Gulf right now is going to China. It's coming from Iran, it's going to China. On a regular basis, pre-war, Iran was exporting 1.4 million barrels to China every day. Now it's still above a million barrels per day going to China. So we're being affected by this, but Iran is able to, take their ghost ships and get out of the Persian Gulf, and that oil is still flowing to China. So keeping an eye on that as well. Something else that is not being talked about, that is below the radar that I'm watching, are the big banks in the United States. That is the worst sector. Year to date, it's down 15% in the past month. The KBE index, so looking at the stock ticker KBE, that ETF is down 15% over the last month, and it's testing its 200-day moving average. So the US banks are so important because they fund so much economic growth, and their business and the reflection in their stock of their business matters greatly. So something else I'm keeping an eye on as well. And so I just want to iterate from 2 days ago that right now, for me, the risks are just too high to start in any new positions. Okay, I've got dry powder, keeping my money on the sidelines. I'm making a shopping list for later on. But like 2 days ago, I just want to remind myself and you as well that going into the war, we were in a precarious situation. And you can go back in episodes and see the whys of that. But I'm not looking for something to end quickly and for there to be a bounce. I'm considering the holistic picture, everything that goes into this. Look, the S&P 500 has been flat since October. We've talked about that range and that compression and how are we going to break out to the upside or the downside. Still watching that, but even though that the overall index has been flat, underneath the surface there has been a lot of decay in individual stock names. So obviously, I'm really cautious right now and always looking for the opportunity, but a lesson that I've learned over the years, and I'm sincere about this, is that one of the hardest things to do is to do nothing, to sit on my hands, to read, watch, analyze, but to do nothing. It is one of the hardest things, absolutely, in my mind, but right now is a time for that discipline, developing that discipline of just sitting, watching, and doing nothing and not taking any action at all is an incredibly important discipline to develop. So the last thing I want to end with is this. It's a simple question, okay? Boiling everything else down. Is now a good time to put new money to work or not? I think you know my answer to that, and I'm always looking at being cautious first and protecting money before putting new money to work. So that's it for today. We'll see where everything goes. Thanks so much. I appreciate you as always, and we will be talking further, of course. Ciao for now.